It's my pleasure to turn it over to Luke and Christine to get us going on today's webinar. Luke, Christine, thanks for joining us.
Thanks, Troy. My name is Luke Flanagan. I'm an investment product director for Fidelity. In my role, I support a broad suite of investment grade and high yield mutual funds, ETFs, and institutional products. Most relevant for this conversation, I support our core fixed income ETF offerings, which we'll highlight in the second half of this presentation. So quickly, I'm going to run through the agenda for today's session. We'll start with a brief 10-minute overview of the fixed income ETF space. This will include the growth we're seeing in the fixed income ETF market, as well as what's driving it. I'll break down some of the important information and distinctions around ETFs and fixed income ETFs more specifically. And then we'll take a look at Fidelity's fixed income ETF offerings, which will hopefully provide you with the feel for the types of funds that are out there and how to use them to accomplish your goals and how to think about this in the context of your overall portfolio. With the background of our lineup, we'll dive into a conversation around the market outlook from the perspective of Fidelity's diversified core bond portfolio management team. I'm lucky to be joined by Christine Thorpe. Christine is an institutional portfolio manager for Fidelity. She supports the core bond team. And with Christine, we'll talk about what's happening broadly across the fixed income markets, expectations around the Fed, overall outlook for the economy, what it means for investors like you, and what you can learn from how this team is positioning their portfolios. So with that, let's dive in and jump to slide 4. So let's talk about why we're here today. Whether you've followed the industry over the last year or the last decade, you've probably been hearing about the growing buzz around ETFs. As of April, US listed ETFs had grown to more than $8.7 trillion in total assets. In the last 4 years alone, ETF assets have grown by 60%. As you can see from the chart on the right, fixed income ETF assets have grown to represent $2 trillion in total AUM. This fixed income ETF market has been growing at a compound annual growth rate of more than 15% over the last 10 years. Now, historically, most investors have thought of ETFs as passively managed trading vehicles. We'll get to the why on that in a minute. But as you can see, while smaller in overall size, in the blue on the bottom right of the chart, the fixed income ETF market also has seen extreme growth in the actively managed ETFs, which have grown by more than 35% annually over the last 10 years. Actively managed fixed income ETFs are the focus of Fidelity's fixed income ETF offerings, and something we'll discuss with regard to our lineup, and we'll get Christine's thoughts on our competitive edge there. On the left, you can see a breakdown of the Morningstar categories, which saw the most fixed income ETF flows in 2023. As you can see, diversified core bonds saw the largest inflows in 2023, and this is an area that Fidelity knows very well. We have the largest active fixed income ETF in the space, the Fidelity Total Bond ETF. So why are ETF assets growing? Let's jump to the next slide. So there's been a lot of buzz around ETFs, and we're seeing particular growth in the active fixed income ETFs. But what's driving this influx of demand? First, let's start with the basics. An ETF is an exchange-traded fund. Over the next few slides, I'll highlight some of the major differences between ETFs and mutual funds. Let's start with where they have common ground. This is highlighted best on the top right bullet in green, diversification. Mutual funds and ETFs pool investor capital together to provide a practical, cost-efficient way to build a diversified portfolio of professionally managed stocks, bonds, or short-term investments. Like mutual funds, ETFs are registered under the 1940 Act as an open-end investment company. They follow the same statutory and fiduciary obligations with respect to fund oversight, and they're governed by 40 Act limitations such as diversification and concentration. So what are the major differences? ETFs take a lot of the best things that we do, that we receive by investing in mutual funds, diversification, portfolio, professional management, and a variety of underlying exposures and investment types, and they combine that with intraday trading, potential tax efficiency, potentially lower costs, as well as enhanced transparency. So now, over the next few slides, we're going to go deeper into some of the differences between ETFs and mutual funds that I've highlighted. Let's jump to slide 6. ETFs trade very similarly to an individual stock. The E in ETF stands for exchange. ETFs trade intraday on an exchange. They allow you to set stop and limit orders, and they allow you to trade on margin. When it comes to mutual funds, when you set the trade for a mutual fund, although you may be doing it during the day, your trade is executed at the end of the day price for that mutual fund. In contrast to an ETF, there's no stop or limit order, and you cannot trade on margin. Let's jump to the next slide. Costs are an important consideration for any investment vehicle. Both mutual funds and ETF have expense ratios. Expense ratios are the holding costs associated with owning those funds. They are typically expressed in annual costs. With ETFs, they trade like a stock and they have associated commissions. For Fidelity, on Fidelity.com, most ETFs trade commission-free. Load mutual funds carry transaction costs, however, while no-load funds do not. And then lastly, while mutual funds transact at the end-of-day NAV as discussed, ETFs have an implicit cost associated with the bid-ask spread. Hopefully that helps. Let's jump to the next slide where we can round this discussion out. On this slide, I'm going to focus my comments on transparency and potential tax efficiency. When it comes to transparency, most ETFs, in fact, all fixed income ETFs, have transparent holdings. Mutual funds, however, typically have lagged holdings. This means that for an ETF, you can look up the current fund's holdings every day. When it comes to potential tax efficiency, in the mutual fund structure, when you purchase shares, you deal directly with the mutual fund. Under this structure, if a client sells their stake in the mutual fund, the manager is required to raise capital required for the client to get their money back. This can potentially cause the fund to sell securities and potentially trigger a capital gain distribution. With ETFs, there's a creation redemption process. This means that instead of selling securities to meet redemptions and create liquidity or cash, ETF issuers can provide securities in kind to authorized participants who can create and redeem shares. The ETF's ability to do in-kind transactions are a benefit to shareholders, helping to reduce transaction costs. In practice, Fidelity looked at active ETFs over the past 3 years, and active ETFs have distributed gains significantly less often than comparable active mutual funds. Let's jump to slide 11 and talk about Fidelity's fixed income ETF lineup. At Fidelity, we joke that one of the best kept secrets on Wall Street is the size and strength of our fixed income division. We are fortunate to manage more than $2 trillion in client assets across all of our fixed income division, with more than 275 fixed income professionals, including more than 125 dedicated research professionals and another 200 equity research professionals. Fidelity has a competitive edge in fundamental research, trading, and portfolio management. We put that expertise into practice managing all of our fixed income ETFs. Fidelity's been managing active fixed income ETFs for almost 10 years, with our first ETF launching in 2014. We have the largest Core Plus fixed income ETF, Fidelity Total Bond Fund. And we also have a wide variety of ETFs available across the credit and maturity spectrum, as displayed on this slide. This allows us to provide our clients with the products that best help them to achieve their investment goals. Today, I'm joined by Christine Thorpe, who's also an institutional portfolio manager for the Core Bond team. The core fixed income ETFs are represented on the next slide, and they include the Fidelity Investment Grade Bond, Total Bond, and Tactical Bond ETFs. On the left, Fidelity Investment Grade Bond ETF is primarily focused on investing in core investment grade exposure. This includes U.S. Treasuries, agency debt, corporates, and securitized assets such as mortgages. The fund keeps its duration mostly in line with the broad-based benchmark, the aggregate bond index. And the total bond ETF invests in all of the same exposures, plus it has additional flexibility to invest up to 20% in below investment grade sectors such as high yield corporates, emerging market debt, leveraged loans, and high yield CMBS. And then finally on the right, the most flexible product is the Fidelity Tactical Bond ETF. While this fund follows the same investment process as the other two funds, it has the greatest flexibility to lean into the portfolio manager's best thinking and evaluate relative value for a flexible mandate. This ETF has even greater flexibility to invest in below investment grade securities compared to total or investment grade bond. And it also has a wider duration band. With that background on what the team manages, I'm fortunate to bring on Christine Thorpe, who's going to answer some questions for us today. Christine, thanks for being here.
Hey, thanks for having me.
So, Christine, let's start big picture. What's happening right now in fixed income, and what's your view on fixed income at the moment?
Yeah, sure. Great question, Luke. So, I got to go back to the start of 2023 when we as a team published a paper titled, "If you don't like bonds now, maybe you just don't like bonds." And I would say, as we fast forward to this year, we still have that same view. And, really, it's just that we remain constructive on the asset class. There's typically three reasons why investors allocate to fixed income, right? That's first of all to generate that coupon or income. Second is to provide capital preservation, and then third to get some diversification benefit. Now, I think in this environment, we can basically check off all three of those boxes. So, first for income, right, yields in fixed income are really in the 90th percentile. We go back over the last 20 years. You really have to go back to even '06 or '07 to get yields this high. Today, the yield on the aggregate bond index, which is really just a broad fixed income benchmark, right? That's right around 5%. And when we compare that to where we were before the Fed started their hiking policy, we were just under 2%. So that's a pretty meaningful increase, and I think represents right a new opportunity to generate income. Now, this additional yield that we see, that really helps with that total return or capital preservation element. So if you think about returns in fixed income, they're really comprised of two pieces. First, there's changes in price on the underlying bonds. And then, of course, you have to add in the income to give you the total return. Now, when we have higher yields, that provides additional cushion against price volatility. So if we go back to bond math 101, right, as rates fall, bond prices go up. And of course, the vice versa is true. And so having that higher starting yield just gives us more cushion if we see rates sell off and bond prices fall. Now, the third component is, of course, that diversification element. And really what we mean there is fixed income's ability to, help offset some, when we have a sell-off in the equity market. Clearly, I think with equity markets hitting new highs this year, that hasn't been an issue. People don't care as much about the diversification benefit, or, if you have something like an everything rally. So go back to Q4 of last year, right? If all asset classes are up, nobody cares about that hedge. But when you have something like 2022, where both equities and bonds are down, that's when people start to pay attention. And what I'd say there is that our view is when the Fed is really the major inducer of volatility in the market, that's when we expect to see more positive correlation, meaning when equities are up, bonds are up, and vice versa. When you have periods where the Fed is not the major inducer of volatility, so think of a geopolitical event, or perhaps some type of growth scare, that's when you see bonds return to their more normal hedge. And I think that's the environment we're likely moving closer towards. So I think we can go check, check, check. Luke, I think we've hit all the boxes there.
That's great. You talked a lot about the Fed throughout those comments. You talked about periods where the Fed was inducing volatility. You talked about raising rates. It seems like we can't, talk about the outlook without talking about the Fed. So what does their path forward look like? And could you shine some light on what the team's thinking there?
Yeah, absolutely. And again, no surprise, that's going to be top of mind for most investors, particularly those that are following fixed income. So again, I'll do a quick recap. When we look at what happened over the course of 2022, then the Fed really raised rates at a historic pace. Of course, all in an effort to tame the path of inflation, which was really, at unsustainable levels. Over the course of last year, they continued to hike, but the last hike we saw was back at their July meeting. We haven't seen anything from them in terms of additional hikes since then. So really, they've been on pause. Now, at the last meeting of the year, so back in December, that's when the Fed indicated that they may cut, perhaps 3 times over the course of this year. Now, when we talk about cuts, by that I mean, think about a cut as 25 basis points. So, or 1/4%. So 3 cuts would equal 75 basis points. Now, when the Fed came out with that estimate, the market took it and ran. The market immediately priced in 6 cuts over the course of this year, which really drove a pretty nice rally across markets. Now, at that point, we did feel like the market really was getting ahead of itself. Our expectation was the economy was more resilient and in a better place than I think many were acknowledging. And we thought the Fed could afford to be patient over the course of this year. We really saw little incentive for them to cut and potentially give up some of the gains they've achieved on the inflation front. And I'd say, sort of our expectation has largely been borne out. So given the inflation prints we've seen so far this year, the market has really pulled back their expectations. They're probably pricing in closer to 2 cuts over this year. I think it's fair to say maybe 1, maybe 2 cuts towards the second half of the year is what we see from the Fed. I do think they want to cut, but I also think they need to have more conviction in the inflation trajectory before they go there. Now, I don't think they feel like they have to wait until inflation gets all the way down to 2%, which we know is their preferred path. But I do think they need confidence that the numbers are trending in the right direction. We've certainly seen significant progress, since the highs we hit back in 2022. This last inflation print in April was right at 3.6% for core CPI. So we're making progress, but I do think the path is going to continue to be bumpy, and it may continue to be that way for the foreseeable future. So if I take a step back, I think the Fed's going to continue to be data dependent from here on out. We're going to approach it the same way. We continue to assess if we think any change in our outlook for their path forward is warranted. Of course, we got the Fed meeting coming up in just a few weeks in mid-June. So we'll be looking at that closely to see if there's any hints on what to expect for the remainder of the year.
Yeah, Christine, that makes sense. And whenever it comes to the Fed, we're talking about the economy. I know they're looking at things like inflation, but could you kind of provide us a more general outlook on the economy? What are you seeing as the backdrop, and maybe what else is affecting kind of what the Fed is looking at?
Yeah, absolutely. So, I said it earlier, but I'll say it again. The economy continues to be pretty resilient. That was really, again, our outlook over the course of last year. And, I'd say the same holds up today as well. We think about the economy, we can't divorce it from the labor market. And, clearly unemployment remains really low. We're still at sub 4% levels. And we've continued to see wage gains at the same time. I think in this type of environment, as long as people continue to have jobs, right, they're likely to continue spending. Now, we're not relying on just the monthly unemployment prints we see every month. We're continuing to, probe at that and test to see if, what's going on under the covers really is bearing out. And, when we certainly always see noise, but when we look at, our own proprietary data sets that we have access to, or we're talking to the many CEOs or CFOs of, the major companies across the US that come in-house to meet with our analysts, right? We're not seeing, significant signs of weakness in the data, or we're not hearing that from the C-suite. So, I think that gives us additional conviction in our views. Away from the labor markets, right? Corporate balance sheets, appear to be in decent shape as well. And, clearly the earnings picture has been really healthy as well. the last point is just, on the consumer, right? And by and large, they seem to be doing okay as well. And again, I think a lot of that's a reflection of the labor market, but I think it's also what consumers are seeing on their own balance sheet. So, whether it's the equity they have in their homes or, what they're seeing in the stock market, they seem to be doing okay. And, when we think about the housing market, most homeowners have locked in really low rates. So they're more insulated from, the higher rates that are there in the market. And of course, that's in a pretty big contrast to what we saw, heading into the GFC. So, I know I've painted probably a pretty rosy picture. I do think it's fair to say, we see the soft landing or, perhaps a very mild recession as the likeliest outcome. But even with that, we are still remaining cautious, and we've continued to position portfolios, which I'm sure we'll talk about, just in a way to take advantage, if we get any type of slowdown that really causes credit to cheapen. I think, there still remains a lot of unknown risks that are out there. So we do think it makes sense to be prudent.
Yeah, that was a lot of good context, Christine. I really appreciate it. You kind of talked about the economy being resilient. Consumers seem to be doing well. Consumer balance sheets are intact. But I think for everyone here today, we're wondering, what does this mean for investors? How should they be thinking about their investment portfolios? And, maybe in a fixed income context, where should they be in the curve? Taking into consideration all the context you've kind of shared earlier about the Fed and rates.
Yeah, sure. First, I'll preface my comments by saying, everyone's going to have a different time horizon or a risk tolerance. So, those are really important considerations for, how any investor is thinking about positioning their portfolio. I think what we have seen over the last 2 years is certainly a lot of interest in the front end of the yield curve. So think of, cash-like strategies like money markets, right? And, that's made a lot of sense just given, excuse me, the inversion of the yield curve and just how high rates in the front end have been. Now, in a normal shaped, in a normal environment, we would expect sort of the normal shape of the yield curve to have longer maturities out yield shorter term maturities. And, that's really because, right, investors are going to demand typically higher rates for longer maturities because there's more uncertainty about the paths of interest rates over that time period. But what we've seen for now going on, well over 7 quarters, is that probably the most common curve people refer to, the 2s, 10s, has been inverted. So 2 years are out yielding 10 years. The 30-year average is for the 10-year to out yield the 2-year by about 1%. Today, the 2-year is out yielding the 10-year by 40 basis points. So, clearly there's quite a bit of room to move once the curve starts to disinvert and steepen out. And we think that the curve is ultimately mean reverting and is going to return to that more normal shape. I think the timeline for that continues to get pushed down the road, just given, again, the overall strength of the economy and, when the Fed may begin to start cutting rates. But we also would say, it's really impossible to time that trade, or it's very difficult to do so, even as professional investors. You never know, right? If something is going to happen unexpectedly, the Fed in that case could cut rates really quickly. And so you have to be thinking about reinvestment risk if you're in, something like a money market strategy. That paper rolls over really quickly, meaning it matures quickly. And so, the question is, right, how long are you locking in those higher yields? And will you potentially miss out on locking in higher yields by moving out the curve? I'd say it's also a different total return opportunity. So, if we go back to Q4 of last year, when we had this major, everything rally, cash returns were extremely low, but bonds returned 7%. And who would have predicted, right, that was when we were going to see that big of a rally? So I think, again, you just have to be thoughtful here. You have to be aware of the risks that are out there. And those are the things that we're certainly thinking about as we position portfolios.
That's great. Yeah, another kind of great set of context. I think, you're talking about, Christine, a little bit there about the mean reverting yield curve and kind of this uncertain timeline that just keeps, things seem to be a little bit pushed down the road. And I think that's probably top of mind for a lot of folks who are listening in today. I think, investors are probably feeling that uncertainty. And so I'd love to hear about, the strategies that you work with on the day-to-day basis and how you're actually positioning these funds kind of in this period of uncertainty.
Yeah, absolutely. So I'll focus on investment grade bond fund and our total bond fund as sort of examples for how we're thinking about it. And we're really consistent across both of those strategies in terms of some of our best ideas. And really, what we're focused on today is just being patient. And sometimes that's really hard to do, to sit on our hands and wait. But that's really our best idea as we wait for more compelling opportunities to add alpha. The environment we're in today, I'd characterize it as one where, yields are high relative to history, but credit spreads are tight, all looking back over the last 2 decades. So put it another way, right? Yields are cheap and spreads are more expensive. And so when we look at we think about it from a relative value perspective, here we prefer yields at this point in the cycle. In the case of, investment grade bonds, we are running longer on duration. We're still pretty close to the benchmark since we try not to make big rate bets, but with our expectation that the Fed is, pretty much done hiking, we want to be ready in case rates start to rally. Now, across both strategies to help with some of that duration positioning, and I'll talk about the curve in a second, where we have been adding is to U.S. Treasuries. We've really been focused on getting bulleted on the yield curve over the last 18 months or so, and that just means, focused on getting more exposure to the intermediate part of the curve. That goes back to my comments where, at some point we do think the curve is going to disinvert and steepen out. Really hard to time that. And so as gradual contrarians, we'd rather start moving there in advance. I think the other part of the being patient and having that allocation to treasuries is that, treasuries represent the most liquid part of the bond market. So that just gives us a lot of dry powder that we can deploy if we see more attractive buying opportunities down the road. Plus, they give us a nice hedge, right, if we get some type of risk off of them. We absolutely still have an allocation to credit across both strategies. Again, we don't see major concerns about the fundamentals out there, just given the health of the economy. Our largest overweights still remain in financials, and that's primarily to the money center banks. So think of the largest banks in the country. They do remain in solid shape, and some of that's just because they've been subject to such stringent, regulatory oversight and requirements and regulations. Now, that said, corporates remain really rich. They're not really pricing in any type of recession risk. And so it's hard to see, an opportunity for them to outperform significantly from here, just given how expensive they are. So we'd rather wait, sit in treasuries, earn a competitive yield with high credit rating, and then, we'll start to add incrementally or in a big way to credit if we see spreads really cheapen out. Now, in the case of total bond, really our largest plus sector allocation remains to high yield and leveraged loans. We have a lot of conviction in, we've had a lot of conviction, I would say, just in our view on the overall health of the economy. That goes back even to beginning of last year when every pundit on CNBC was calling for a recession. And so, having that exposure on was really the biggest driver of our alpha over the last year and even into this year. Both sectors were up over 10% over the course of 2023. So really additive to our portfolios. Now, we're not adding significantly to those pockets, to both of those sectors. just given, where we are in the cycle. But, when we talk to the PMs that run those sleeves, they're not seeing widespread stress in either sector. And in fact, issuance has been really healthy. So, we think we're getting adequately compensated for, the higher risk of holding those allocations. And I'd say that's probably most notable in leveraged loans, which is really a floating rate market. And there, the yield on that sector is about 9%. Again, that's pretty, significantly higher than the yield on the aggregate bond index at 5%. I'd just say, Luke, broadly, we are trying to be really thoughtful about how we make these types of sector calls, right? And what we're doing in terms of security selection. And again, I go back to your comments, just, given the size of the fixed income assets we manage at Fidelity at $2 trillion, right? We got a lot of resources and expertise to help us navigate these types of markets and make those decisions.
Yeah, I love that. And, Christine, one thing that I think you slipped in there that I don't think most people caught was you mentioned the team's gradual contrarian approach. And I'd love to hear you expand on what that means. And then maybe just talk a little bit about where you're being cautious. There's a lot of positives. I think you have a lot of deep conviction ideas, but where are you seeing a little more stress, or where are you being cautious today?
Yeah. So thanks for picking up on gradual contrarian, Luke. So, all that means is that, we typically will start to allocate, excuse me, into a sector, when we think it's undervalued or when we think it's cheap. And then we'll start to rotate out of that sector, when we think it's gotten too expensive. What we found is, doing that consistently over time, adds to our outperformance relative to our benchmark. Now, there are times where we may be a little too early, we may be a little too late, but we'd rather do it that way and make sure we're capturing as much of the opportunity as possible. We certainly have the ability to move quickly when we need to and add risk in a big way. Again, we see a really big opportunity in the market, but typically, those are reserved for certain situations, and you're more likely to see us move gradually. And, I think that's a perfect way to describe sort of, some of the actions or trades we've done in the portfolios over the last year. I mentioned, we really like some of the fundamentals. We feel good about the economy, but, just because some of these sectors have been so expensive, we really have been just broadly de-risking portfolios. And trying to move a lot of that exposure into treasuries. I think for investment grade corporates, we've probably taken that allocation down as low as we will. With spreads being so tight, it's really, again, hard to see the potential for much excess returns from here. We're really focused on short and intermediate corporates. Long corporates can be a more inefficient part of the market. If you get small moves in spreads or prices, that can really wipe out a lot of your carry advantage over short and intermediate corporates. Within total bond, I'd say, while we still like our high yield and leveraged loan allocation, we're not really adding there. Certainly the strong fundamentals, and the issuance we've seen, right, that's helped push out the timeline with debt and loan maturities. So that's positive for the market. We've continued to see defaults pick up slightly, but they're still pretty low relative to history. So again, I'd say, we're being cautious. We're watching the sectors. If we get more concerned about the fundamentals, you may see us, take down some of those exposures even further. But right now, we're just, again, preferring to be patient and wait to see what other opportunities are out there.
Yeah, that's a really great, thorough perspective. Christina, we got two more really good questions that I want to get to. But before we do, I just want to pause and remind folks about the Q&A functionality, and just to remind everyone to get those questions in, because we're going to answer some questions at the end. But Christine, back to you. So you're kind of taking us through the positioning, but what's the outlook for the remainder of the year? How are you navigating through 2024?
Yeah. So, I think it all comes back to the Fed. We think the most likely outcome, as I've said, excuse me, is most likely that soft landing or a very mild recession. I think if we're in that type of environment and inflation continues to trend down, again, I think the Fed will be able to cut rates, and they'll probably do it in a pretty gradual fashion. Now, that may be a small positive for the bond market. Now, if we hit turbulence and we get some type of hard landing, right, that's when we expect the Fed is going to cut quickly. Credit's likely to underperform in that type of environment. But again, I think treasuries will be a hedge, and we'll probably see a positive outcome for fixed income. Again, in our strategies, that's when we would be looking to add credit. In the past, doing that type of move when credit bottoms out has been really additive from a performance perspective. That was our experience back of March of 2020 in the early days of the pandemic. So likely, not that I'm hoping for a pandemic, but if we see some type of big vol event, right, that's when we'll be looking to add. I'd say out of the sort of the third scenario, and what I'd say is really the least probable, is that inflation reignites and the Fed has to entertain hiking again. Now, in the May meeting, right, it was clear that wasn't on the table for them. And I think it's hard to see a catalyst for inflation to really take off from here. But of course, again, we're going to be watching that data closely and see if, a change in our views is warranted. And I think the nice part is, we've got a lot of flexibility within our portfolios to move either quickly or gradually. And, we'll just do that when we think it makes sense to do so.
Makes a lot of sense. It's very convincing the way you kind of put that. I'd love to, we've kind of heard a lot about the sectors we're invested. We've talked about the outlook generally, but I'd love to bring this back to the ETF focus. Could you tell me a little bit about, the passive versus active and what that makes you think about when it comes to the opportunity set and how we're taking advantage of that here at Bell?
Yeah. So, when we talk about a passive ETF or a passive fund, right, that just means that the fund is trying to track the returns of the benchmark that they follow. So they're going to look the same in terms of the overall risk level, and whatever the index delivers is going to be close to what the passive ETF delivers. Active just means this is where portfolio managers have discretion to take on different risk relative to their respective benchmarks. So they may take on more credit risk, right? So in the case of total bond, I mentioned we have an allocation to high yield and loans, or they may decide to take on more interest rate risk. So in the case, for example, we were talking about an investment grade bond. Right now, we've got more duration on than the benchmark, or we're more positioned for we're taking an active yield curve position, just given our expectations about how the curve of the shape is going to shift. And so, that's where you can get differences in performance in the active fund relative to the benchmark. Another consideration is, in an active strategy, you may see allocations to, again, sort of out of benchmark exposure. So I mentioned total bond, high yield, and loans, but even in something like investment grade bond, we may at times hold TIPS, which is outside of the aggregate bond index, or we may hold AAA CLOs. So it's just a wider opportunity set, I think, for active managers to generate returns. And, in this current environment, we are seeing, I think, more interest in active fixed income than we have of late. And I think that's, again, sort of just a reflection of, if you think there's more return opportunities in the market. For example, if you want a strategy where the investment team is going long on duration, they're taking that active yield curve position. From our perspective, we've always believed that active fixed income can add a lot of value. And we think that's particularly true for managers that have really deep resources and expertise to navigate these types of markets and, get calls more right than wrong over the long term. So, and we've seen that really play out in the track record of our strategy. So, take Fidelity Total Bond. even through Q1 of this year, if we look at rolling returns, rolling 3-year returns, and we go all the way back 20 years, so really over the life of the strategy, we've seen that we've beaten the benchmark 80% over those periods, while maintaining a really similar risk profile to the index. So that just comes back to we're really focused on strong, consistent, competitive, risk-adjusted returns, and we think there's a pretty big opportunity set for active fixed income.
That's great. Well, appreciate the comments, Christine. I'm going to turn it back to Trey, who will, I think, lead us through some Q&A.
All right. Yes, Luke, Christine, thank you very much. We did have a ton of great questions, so thank you to our audience here as well for sending those through. For our audience, I just wanted to note, too, we had a lot of questions today about some of the individual expense ratios, fees, and performance of the funds. Definitely encourage you to download the slides directly below that viewing screen. You do have a button to download. There are a ton of slides in the back of the presentation that go through the individual funds, recent performance, all of that information. And as always, you can head to fidelity.com. All of these funds can be pulled up in our research for that additional information. So if we didn't get to all those, just wanted to let you know some of the resources that are out there for that. So let's jump into the questions. This was a popular question in registration and now our top voted question here as well. Of course, today's focus was on fixed income ETFs, but kind of a comparison question. William had asked, what are the advantages versus disadvantages of holding a fixed income ETF versus, say, just doing individual bonds themselves?
Yeah, Trey, I'm happy to start there. Luke, feel free to jump in. I think, a lot of it comes down, in my view, to, what's most important to a client. So, I think with an ETF, right, you get that professional investment management. I think we've talked about some of the ways, right, we're trying to navigate the current environment. I think you also get access to, institutional trading capabilities, right? So we have a large trading desk here in Merrimack, New Hampshire, which is where our fixed income trading floor is located. So, we certainly rely on our traders' expertise to navigate these markets. The other part I would just highlight is, I think we get access, you can get access through an ETF to sectors that you may not be able to on your own. So there's certain sectors like commercial mortgage-backed securities or CMBS, which typically you have to have a very high asset level in order to be able to invest in those sectors. Similarly, we may go down in credit quality. So in our strategies, we extensively invest in BBB rated investment grade corporates. We think there's a lot of spread dispersion, so meaning there's a wider variety of pricing on those bonds than what you see up in quality. So, even across single A's. And I think sometimes individual investors have less confidence in investing in some of these lower quality bonds because of just concerns about credit quality. On the flip side, I think many want to have sort of that transparency into their portfolios. They want to be able to go out and pick and choose which bonds they're putting in there. They may want to tailor it to whatever their specific outlook is, or if there's a sector they want to avoid. So it's just that customization piece that you can clearly do that much more easily if you're going out and picking and choosing your own bonds. And certainly not the expert here, but I know we've got a lot of tools for anyone that wants to go out and do that within their own portfolios on fid.com.
All right, great. Thanks so much for that answer, Christine. Hopefully that helps everyone as well. Very popular question that's out there. I want to throw another comparison question out to you, if you don't mind, as well. This also, we got a great question in registration from James. Just asked if we could compare, contrast fixed income ETFs versus a bond separately managed account. And if you wouldn't mind too, just going over a little bit about what that separately managed account is for anyone that's not familiar with that.
Yeah, certainly. And I'll say, we manage both of these products within our fixed income organization. So I think that's a nice thing. We have choice available. The managed accounts, really all it is, what that means is, you are hiring, in the case of the strategies we run, you're hiring Fidelity to go out and pick those individual bonds for you. So you get access to that professional management. Our portfolio managers are thinking about, right, how do they manage the overall interest rate risk of the portfolio? They're going out, again, sourcing sort of the best ideas from our research analysts and talking to our traders about where we find the most relative value opportunities, and then as well as diversifying across, different sectors. So making sure, for our core taxable strategy, we've got allocation to treasuries. We have an allocation to agency mortgages and corporate bonds as well. So again, I think if you want some level of transparency, you want to be able to see all of the bonds in your account, you want to see all the trades that we are doing on your behalf, that's what you can access through a managed account. Similarly, we do allow some level of customization. So at times, not always, we always review them, but at times there may be, an issuer you want to exclude, or some sectors. And so at times we can accommodate those within a managed account. Again, I think the difference is for an ETF, that's a really liquid vehicle. So you have access, right? If you need to withdraw cash, it's very easy to do so. You're getting access to a wide variety of sectors, including out of benchmark exposures that we think can add a lot of value, but you're still getting that professional management. So again, I think it comes back to investor preference and really what's ultimately most important to them.
All right, perfect. Thank you so much for that one, Christine. I want to ask a question here that relates a little bit to the slide that we have up right now with the credit spectrum between investment grade and high yield. Sort of ask, what's the major difference between investment grade versus non-investment grade? And as we look over the spectrum of ETFs as well, how does this factor into management, or how maybe someone is deciding on choosing one fund versus the other?
Yeah, maybe I'll jump in here, Christine, and just orient folks to the slide that we're seeing. So under the type on the bottom left, this is where folks are seeing the investment grade versus non-investment grade. And it really helps distinguish between, the fund is typically invested in higher risky or less risky investments. And so below investment grade often refers to high yield or similar securities, which can be lower in a company's capital structure or generally have higher risk. Christine, is there kind of anything I'm missing there?
No, I would agree with that, Luke. I would offer up our high yield strategies are managed by our high income team in Boston. They've got deep expertise in those strategies, whereas the investment grade offerings are managed here in Merrimack, New Hampshire. But again, we're one broad organization, so we collaborate and work really closely together, particularly in those strategies like a total bond ETF or tactical bond, where we're allocating to the high yield teams as well.
All right, great. Thank you so much for the insight on that one. Had a question here too from Bert, also at the top of our list here regarding tips. And really the question was just, given the uncertainty of inflation, is there still a role for the Treasury inflation protected securities or tips funds for an investor?
Yeah, I think it's a great question. I think it comes back to, again, how are folks looking to use that allocation? I will say in our core and core plus and tactical strategies, there have been times where we have owned tips. It's really when we think they offer significant relative value opportunities. So basically, we may allocate to tips when we think the pricing on there does not reflect what may happen with inflation over the coming months. So we, for example, added tips back probably around the pandemic when we thought inflation was more likely to take off, and have since sold out of those holdings. I think from our perspective today, tips seem to be pricing in where we expect inflation to go. It's close to 2.5%. So we don't see as much value there. But I think again it sort of depends on how you're looking to use them. I will say I think the one part about tips that people struggled with back in 2022 was that tips do have duration associated with them. So when the broad bond market was down, tips were down as well. So you just have to remember that they are bond securities at the end of the day. There is interest rate risk that's associated with them. Again, it may be appropriate to hold them at times, and there may be opportunities, but I think that's an important consideration when looking at those allocations as well.
All right, great. Thank you for that one here. Maybe try and squeeze in one more here before we wrap. Luke, at the beginning, you spent some time on ETFs versus mutual funds, but had a few questions that came up after as well. Really, this one that came through is: are there any advantages to an actively managed fixed income ETF versus, say, an actively managed fixed income mutual fund?
Yeah, thanks for asking, Trey. I think we talked a lot about the advantages of the ETF trading structure and the ability to price intraday. I think at Fidelity, we have kind of gotten to the point where we manage ETFs and mutual funds almost agnostically. So from a portfolio management perspective, we really can run strategies regardless of vehicle type. And so ultimately, I think it comes down to where you're buying the vehicles, what makes the most sense for the underlying asset class that you're getting exposure to, and then ultimately, what's available to you. I think we can at Fidelity we can offer both ETFs and mutual funds, and for example, our total bond strategy, we do have both. And there are some advantages to ETFs, like I've kind of highlighted, and there are some places that mutual funds may make more sense. And I think it really comes down to a client by client decision when it comes to individual vehicle choice.
All right, great. Thank you so much for that insight, Luke. With that, we are pushing up at time, but before we close, I have just a couple of quick reminders that I'd like to send out to our audience. First and foremost, we do appreciate everyone joining us today. Thank you for all the questions you sent in, both live and through registration. Those questions through registration help us, shape the show and make sure that we're structuring this towards what you're interested in. So we appreciate that. Do want to let everyone know after the show, we will send a thank you email out. If you have additional questions, if you'd like to maybe have a discussion with the Fidelity representative, someone that we can locate that helps fit your needs and help answer those questions, there is a link in the email to help you get set up with somebody. So please take a look at that. We also have some additional research available for you in there as well. We talked a lot about the different funds. There'll be a link in the email today that will help you find the Fidelity bond ETFs that we discussed here today and help you dive in and do a little bit of additional research if you want to learn more about any more of those funds. So definitely encourage everyone to take a look at that email, follow those links. Those should be very helpful. But with that, we will close it up from here. Luke, Christine, we want to thank you both once again and to our audience, and we'll look forward to seeing everyone at the next one. All right. Bye-bye.